I just think that the reality of the last 2 years has shown the market's more on top of the deflationary cycle than the Fed. The Fed has consistently overestimated the amount of inflation coming through. Like, you see it in they do what's a 1 and 2 year outlook, and they release it every 12 months or so, and they have to update it. The dot plot's part of that cycle. They've been wrong the whole time. If you want to we can go off on a slightly esoteric answer, but basically they are confusing the functioning of the system pre-China up to 2002, where loose monetary policy and employment did result in wage inflation, with a post-China WTO globalised outcome, which it's a bit correlation pre-2002 was a 0.8 correlation between monetary policy and employment. It's dropped to less than 0.1, i.e. there is no correlation now. And they're stuck in the old mindset. And every time they get to the point where they've got to raise rates, the reality stares them down. So if they do go, they'll communicate it before they go, so we'll find out. But the point the market's trying to get across at the moment is not whether they go in September or December or March, it's they ain't going very far. And there is one other point I'll raise on this, that they're confusing nominals and reals on wages. Is if you look what wage growth was running at in the mid-1990s, you had productivity running in the 2s to 3s. So you could pay your staff 5% more and actually only be paying them 2% real terms more. Productivity at 0 and nominals of 2 to 2.5 is reals of 2.5. You're actually paying your staff the same pay increase as what you were, given what they're producing in the mid-1990s. So you're already there. So the economy can't actually grow much quicker unless productivity fixes, and the Fed can't fix productivity. It does monetary policy.